I want to go over the Vale cost of borrowing case example one more time, just to clarify a few things. Just first, let me briefly discuss the data that we have about the case. As I mentioned in the class discussion, Vale is a Brazilian mining company. It generates most of its cash flows in US dollar because its products are priced in US dollars, and as a result, it sees US dollar as its natural currency habitat. The company needs to fund a major initiative and is looking for funding opportunities. It is contemplating three different alternatives that its bankers introduced to them. The first option is a annual bond issue, 8 years maturity with a coupon interest of 5.24%. This is a $1 billion face value issue. So they will be able to place the bond at the face value, so at the par. Practically, they will be able to raise $1 billion with a 5.24% coupon. That means that in this segment of the market, required rate of return by the investors is 5.24% in dollar terms. In the euro segment, they think that they can raise 750 million euros at a coupon rate of 4.375%. This is also an 8-year bond. And they also think that this bond could be placed at par. So required rate of return in this segment in euro terms is 5.375%. The third alternative is a pound denominated bond. Again, 8 years maturity, 700 million British pound face value. The bond can be issued at 5.475% coupon. Again, in pound segment, required rate of return is apparently 5.475, so that the bond can be issued at par. In all of these cases, the company faces a 2% issue cost. We will have to factor that in when we calculate companies' borrowing costs. So the question is, what issue should Vale gravitate towards? Assuming that the Vale is going to be able to hedge its euro and pound interest payments by using forward contracts. So that's an assumption that we're going to use in this case. And let me go over other data that we are given in this case. We have the spot rate for euro US dollar, $1.3739 per euro. British pound US dollar rate is 1.5296. And we are also given some sort of a yield curve data. The 1-year interest rate, for instance, in US dollars is 0.492% annualized. 2-year interest rate is 1.0884% annualized. And 3-year interest rate is 0.169% again annualized. And all of these interest rates are expressed in annualized terms. For instance, you could put your money in a let's say 1-year government bond and earn 0.492%, and you could put your money into a 2-year bond, and annual return that you would earn is going to be 1.084%. in 2 years, obviously, you would earn a square of this compound interest that you would earn in 2 years. So 2 years out, so $1 that is invested today is going to grow into 1 plus 1.084% to the power 2 in 2 years. So we should consider these interest rates when we think about when we consider the forward rate calculations. So we have interest rates given in 3 different currencies, as you can see in here. We have US dollar interest rates, euro interest rates, and British pound interest rates up to 8-year maturity. So this, for instance, 8-year interest implies annual rate of 3.486, provided that you invest your money for 8 years. That would mean you would earn 1 plus 0.03486% to the power 8 compound interest over an 8-year period. Also, we were given risk-free interest rates in US dollar, euro, and British pound in this line. So we could highlight those maybe. And then we do have AAA and BBB corporate interest rates in here. So let's figure out which one of these bond issues would be more advantageous and analyze and make a decision about it. So the task requires us to calculate US dollar cost of each of these issues, all in cost, US dollar cost in all of these 3 issues. So first, we will for the euro. This is actually a euro bond issue, right? Euro bond issue, and this is the pound bond issue. For each of these issues, we are going to evaluate the dollar cost and compare them. So all-in cost US dollar, this is already, all the cash flows are in US dollars, so it is going to be easy to calculate. But in the euro bond, we have euro cash flows for the bond. We are going to estimate or calculate the forward rates, and by using forward rates, we are going to calculate the hedged US dollar cash flows. And based on that, we are going to calculate the all-in cost. We will do the same thing for pound cash flows, and incorporating the forward rates, we are going to calculate the all-in cost for pound bond issue. So let's start with the US dollar bond. I just calculated in here the principals that are going to be sold. So the bond is going to be sold at par, $1 billion bond. We will incur a 2% fee. So net amounts of funds that we're going to clear out from this issue is going to be $980,000. And the coupon interest for the US dollar bond is 5.24%. So this bond will bring in $980,000 to Vale, but it will require cash outflows of 5.2840% times 1 million face value. So interest is going to be charged on the face value of the bond. So the annual cash flow is going to be in US dollar terms, $52,400 $52,400,000 per year. So let's copy these through. The last year, we will also make the principal payment. So we need to also add the principal to this last payment. Our last payment is going to be, just enlarge this a little bit so that maybe it can be better reviewed. So our last payment would be $1,052,400,000. So from here, we can easily calculate the all-in cost of this bond. All-in cost implies or can be calculated by simply calculating the internal rate of return of the stream of cash flow. So we can calculate this by using internal rate of return of this stream. So since we received this and paid out this, so the receipt also includes the transaction cost. That's why we call this all-in cost, because we accounted for the transaction costs in here. And if you do the math, it turns out to be 5.56%. So this bond is going to cost us 5.56%. I just want to write in here the cash flows without transaction cost in here, so that we can calculate the yield to maturity of this bond. Because from the from the investor perspective, investor is going to pay for this bond the nominal value of the bond, right? And then is going to receive these cash flows. So if you copy all of these in here, these are all the receipts that the bond investors are going to receive. So yield to maturity of this bond then can be calculated as internal rate of return of this stream. So it is 5.24%. The risk-free rate of return is the 10-year treasury that was given as 3.83%. We're going to use that as a benchmark. So that gives us a credit spread of 5.24, that is yield to maturity minus the risk-free rate of return. So that means that this bond, actually, Vale has a 1.41% credit spread, or 140 basis points credit spread. You can also calculate the transaction cost, which is the difference between all-in cost and the yield to maturity. So we have the transaction cost in here. So all-in cost is essentially composed of the risk-free rate of return. So let's calculate that risk-free rate of return plus credit spread plus the transaction cost. So we verified our calculated all-in cost by using these three components. Okay, so risk-free rate of return, credit spread, transaction cost combined determines the cost of this bond issue. So if Vale were to choose this bond issue, its cost would be 5.56% in US dollar terms. So let's try now the same thing for Euro bond. So this Euro bond, again, has a face value of 750,000 euros. There's going to be a 2% transaction fee or issuance fee. Net funds that is cleared by Vale is going to be 735,000 euros, and the coupon interest is 4.375. So if we look at what Vale is going to receive out of this bond issue after paying for the issue cost, it is going to receive 735,000 euros, and periodically is going to pay 4.75% interest on 750,000 euros. So I'm going to fix this so that I can copy this through. So I'm pressing F4 to fix these, and I have now $32,812,500 of euros of coupon payments. So if I copy this through, I get all 8 years of coupon payments. In the last year, we will also pay back principal. So I need to add the 750 million principal payment in here. I got my euro cash flows in here. So now, since we are looking for the dollar cost of this bond, we need to calculate the hedged US dollar cash flows, and then we will calculate the all-in cost based on these hedged US dollar cash flows. So first, this means that we need to calculate the forward rates for euro US dollar rate. So in time zero, we have the spot rate already. So spot rate was given here as 1.3739. Based on interest rate parity implied forward rates, we can calculate the forward rate as 1 plus US dollar interest rate. We have the 1 year interest rate in here. So this is going to be power 1. We're going to use this, divide this into 1 plus euro interest rates, which is 1.1%. Again, we're going to take the power 1, like in this case. So that gives us the 1 year forward rate as 1.3656. So I can practically copy through this entire stream. Note that I fixed the spot rate because the forward rate for 2 years is going to involve the spot rate at time 0 times 1 plus 2-year interest rate to the power 2 divided into 1 plus 2-year euro interest rate to the power 2. So the second one will involve the power 2, and that is 1.3634. And the third 3-year out forward rate is going to be 1 plus, spot rate times 1 plus 3-year interest rate to the power 3 divided by 1 plus 3-year interest rate to the power 3. So that one is going to be 136.84. And as you can see, this is initially the interest rate in the US was lower. Actually, it is lower, and then in year 4, US dollar interest rates start to increase, so that dynamic is going to change a little bit. So if we copy this through, let's see if we're going to get, so spot rate 137.39, 1 year forward 36.56, 2 year forward 36.34. 3-year forward is 136.84, and so on. So it goes on, but eventually US dollars starts to depreciate because US interest rates initially US interest rates were lower. There has been a little bit of appreciation, but US interest rates started to go over European interest rates, and after this point on, the dynamic is changing. US interest rates are higher. As a result, there is a depreciation. First, an appreciation because of the lower interest rates in the US, but then forward rates reflect higher US dollar interest rates as we see in here. So from here, we could calculate the hedged US dollar cash flows, convert the euro cash flows at the forward rates. Obviously, this is a spot rate, but every other rate is a forward rate. So we are going to multiply the forward rate and the euro payment. So if you can copy these through, you will get all the hedge cash flows. Now we have US dollar cash flows in here, right? So these are going to be the hedged US dollar cash flows for this bond issue. And we can calculate now the all-in cost as the internal rate of return of this entire stream. And that turns out to be 5.006%. In order to calculate the yield to maturity, I need to use US dollar cash flows with no transaction costs. So what we can do again is to calculate what the investors would actually pay for this. The spot rate times the face value, because they're paying 750 million euros to purchase this bond. And then they're going to receive all of these cash flows that are listed. So if I copy this through, I get all of the cash flows that investors are going to receive. So investor pays this amount and then in exchange receives all of these cash flows in exchange. So yield to maturity is internal rate of return of that stream. And I can calculate this as 4.754%. Risk-free rate in US dollars from here again 3.83%. This and then I can calculate the credit spread as the difference between yield to maturity and the risk-free rate of return, which is, I did this back. The transaction cost is the difference between all-in cost and yield to maturity. And as we did before, we can verify that risk rate of return plus credit spread plus transaction cost is equal to all-in cost that we calculated before. So all-in cost for this bond is 5.6%. Just want to bring to your attention that the credit spread in this case is not the same as the credit spread in this case. So we have a credit spread differential. This is most likely because of the required rate of return that is demanded in euro terms had some mispricing of the Vale's credit risk. So this discrepancy obviously is the reason why we check the opportunities across currency segments, because this suggests that the international Fisher effect is not really holding. That is, we are not, the investors are not earning the same rate of return on the same risk company, regardless the currency. For instance, Vale is the same company, but if Vale is borrowing in dollar segment, it faces a credit spread of 1.41%. but it borrows in the euro segment. It's dollar credit spread, dollar denominated credit spread turns out to 0.93%, 93%. So that just suggests a mispricing. And that is actually the reason why corporations can find opportunities to borrow advantages in different currency segments. So let's try the same thing to see what we will find out in the pound segment. So let's see how that will pan out. So let's look at the pound deal in here. It is 700 million face value issue with 2% transaction cost. Net funds are going to be 686 million pounds, and coupon interest is 5.48%. So Vale is going to receive 686 million pounds out of this deal, and is going to pay 5.48% coupon interest on 700 million pounds. And again, let's fix these so that we can copy these through. So if you copy this through 8 years, annual coupon payments of 38 million to 325. And in the last year, we will also have the principal 700 million pounds. Oops. Wrong place. So add the 700 million principal paid out in here. Now I need the pound forward rates. The spot rate for pound is equal to 1.5296 in year 0. 1 year forward rate is going to be 1 plus US dollar interest rate that I have in here to the power 1 for the first year divided into 1 plus the British pound interest rate, which is 1.154%. Power 1 again. Here. So I get 1.5196 for the 1 year forward rate. And if I copy this through, I will get 2, 3, 4, 5, 7, 8 year out forward rates. So the pound, as you can see in here, dollar is appreciating because if you look at the relative interest rates in here, dollar interest rates are almost exclusively every year is lower, although the wedge is just sort of getting smaller and smaller. But as a result, US dollar appreciates in the forward. And if you calculate the hedged cash flows for pound, convert these into US dollar at the forward rates, copy this through. These are all the dollar cash flows. So now I have the hedged US dollar cash flows, and I can calculate the all-in cost as internal rate of return of the stream. And that turns out to be 5.22%. In order to calculate the yield to maturity, I have to do the same thing that we did before. Investors would pay 700 million for this bond, but in exchange, they're going to receive this stream of cash flows, US dollar. Oops. So here we multiply that with the spot exchange rate of 6. And then we are going to enter other cash flows so that now we can calculate actual yield to maturity of the one in US dollar terms. So yield to maturity in US dollar terms is hedged in hedged terms is going to be 4902. Risk-free rate again is let's pick up from here 3.83%. Now we can measure the credit spread in the pound segment. As you can see, it is 1.076%. It is more than 100 basis points, a little bit larger than the other ones. So if we get the transaction cost between all-in cost and yield to maturity, 0.32%. So we can verify this again. This rate of return plus credit spread plus transaction cost, we get 5.22%. We just verified our all-in cost. So what is the moral in here? As again, if we check out the credit spread in the pound segment, our dollar credit spread is highest. Actually, this second highest as compared with the other one. So it appears to be that the company would benefit in borrowing in the pound. I'm sorry, in the euro segment. It will attain the lowest cost by borrowing in this segment. So we could just highlight this. So among the three borrowing opportunities, the best opportunity is in euro borrowing. So a few maybe important issues that we should emphasize in here. One is maybe a computational clarification. All-in cost of a bond is the internal rate of return of a bond when we also consider the transaction cost. So when we calculate the all-in cost, we look at the net receipt out of the issue and laying out all of the bond cash flows, we calculate, or the loan cash flows, we calculate the all-in cost as internal rate of return of the stream of cash flows. So we calculated all-in cost in this case. So this cost includes also the transaction cost. The second calculation that we engaged in was yield to maturity. Yield to maturity is simply is the internal rate of return of the bond cash flows from the investor's perspective. Investors are paying, in this particular case, for instance, the face value of 1 million, and they are receiving these stream of cash flows. So when the investor pays 1 million and receives all of these cash flows, what is the rate of return that the investor earns? The internal rate of return of this stream is the bond's yield to maturity. The difference between the all-in cost and yield to maturity gives us the transaction cost. So that's actually what we calculated in here, right? All-in cost minus yield to maturity gives us the transaction cost. The yield to maturity is essentially equal to risk-free rate of return plus default risk premium or credit spread of a bond. So yield to maturity then, since it is composed of risk rate of return and credit spread, from yield to maturity, if you know the risk rate of return, we could solve for credit spread. This is what we did. Actually, we just extracted the credit spread for this borrowing from the investor's perspective as 1.41%. So investors, when they invest in Vale's dollar-denominated bonds are demanding a 1.41% default risk premium or credit spread. We did the same set of calculations in both euro and pound segments, but all of those calculations were executed after we calculated the hedged US dollar cash flows. Note that none of these calculations involved euro or pound cash flows. So for instance, in this case, we calculate yield to maturity by assuming that the investors paid a dollar amount, which is equivalent to 750 million euros, because they paid 750 million euros. We converted that at the spot rate to 1,030,425,000. And then also we converted all of the euro cash flows that the investors are going to receive at the forward rates into US dollars. And then we calculated the yield to maturity based on that. So that was the basis of our credit spread calculation. And also it was the basis of our transaction cost calculation. So what we found out that in the euro segment, the credit spread that the investors were charging for Vale was 0.93%. So it seems to be among the three segments, euro segment is the most advantageous for Vale. Apparently in this segment, Vale's credit risk is underestimated, unless it is overestimated in these two segments. But it is likely that European investors see a lower risk in Vale. So essentially, the source of this lower credit spread is this yield that investors demand. Otherwise, we should have all of these credit spreads to be equal to each other. So again, this explains why screening across currency segments makes sense for corporations, because these type of situations occur very often. So this concludes this example. I will post this along with this video, and I hope it is clear to you. If not, we can address this in personal communication. This ends my discussion of this case.